everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. And this week we're going to discount the DC effect in the bond market. And one thing we've certainly seen underscored here in the early parts of 2025 is that the bond market can change its mind very quickly, specifically as it relates to policy emanating from Washington, D.C. And following President Trump's election win, the dominant theme in the U.S. Treasury arena was that his administration's policies would lead to higher budget deficits, increasing Treasury supply, and ultimately resulting in higher rates for maturities like the 10-year yield. Now, let's fast forward about 50 days into the new federal government setting, and the narrative has shifted in a rather visible fashion. And at the present time, the Treasury market's now looking at the uncertainty quotient of changing tariff prospects combined with the prospect of federal worker layoffs, and the 10-year yield has fallen more than 50 basis points from its mid-January high watermark and resides where it was trading prior to Election Day. I like to say, hopefully I don't bore you with this, but if you know Rip Van Winkle, if you looked at the 10-year Treasury yield right before Election Day to where it is now, it's essentially unchanged. And you'd be going, what's the big deal? What's happened? Well, we've certainly seen a lot of volatility in the interim, that's for sure. And what's the certain uncertainty? Well, in terms of potential tariff impacts, one thing that we can be certain of is continued uncertainty. The ultimate impact on the U.S. economy and inflation is still an unknown at this point in time. However, we may be seeing signs of some effects in the recent merchandise trade data where imports surged. And conventional wisdom appears to be that this increase in goods being brought into the U.S. is due to domestic businesses front-loading these imports before the tariffs take hold. And if that's the case, these higher imported goods can end up becoming a buildup in inventories and serve as a somewhat offsetting factor when you actually do real GDP calculations. But it's jobs, jobs, jobs. And that brings us to perhaps the more pertinent part of the equation, at least for now, and that's the labor markets. And concerns are mounting in the bond market that a surge in federal government layoffs will not only negatively impact upcoming monthly employment reports, but that there could also be an adverse ripple effect into the private sector. And it's against that backdrop in the months ahead, investors may not only be focusing on the traditional total non-farm payroll number that we got this past Friday, but also giving heightened scrutiny to the private payroll figure, right? Let's take out government employees. What's the underlying trend? And with that being said, the February jobs report revealed a still relatively healthy labor market setting, but it also began to show signs of this potential DC effect, i.e. federal employment. And while the gain in total non-farm payrolls came in relatively close to consensus, federal employment did fall 10,000. But private payrolls produced a consensus-like gain of about 140,000. And it's also important to focus on what was the underlying labor market trend as we entered into this uncertainty, right? I mean, you want a nice, healthy background to perhaps absorb some of the blows if, in fact, they do come. And what we're seeing is that the 3-month moving average for private payrolls did drop from where we were in January, but the level came in at a relatively good showing of 169,000. In fact, other than the very robust performances in early 2023, the current level stands above the majority rate of increases that have been witnessed over the last 2 years. So where does the bond market go from here? Well, it does seem reasonable to dial down real GDP estimates. Once again, bond investors are faced with a validation moment in the Treasury market. Not only will future evidence be needed to support the recent rally in rates, let alone to see them go lower from here, but the next phase in the DC playbook, that's extending tax cuts, etc., may not prove to be very bond market friendly. In other words, it's all going to remain a very fluid situation. So that's it for me. Have a great rest of the week, everybody, and be well.